Welcome back, ladies and gentlemen, to the Capital Control Show. I'm your host, Derek Gerning, and it's a pleasure to have you today. Thank you in advance for all the likes and shares and subscribing that people have been doing over the last couple of episodes. I greatly appreciate it, and I hope that this episode will be helpful for you as well. Today, we're going to be talking about the intricacies of banking. How do we utilize our infinite banking policy in not only our personal lives, but today we're going to be focusing in on the commercial aspect. How can we use this with our businesses? If you're an entrepreneur or a business owner, this may be extremely pertinent to you. This could be as broad across many sectors. If you're a doctor, dentist, pilot, if you own your own small manufacturing company or construction business, it doesn't matter. Infinite banking can be utilized in all sectors across all market spheres, big or small. And this is very common. In fact, many of the large corporations throughout the U.S. are utilizing whole life insurance as a system to store capital because it's tier 1 capital. It looks great on their balance sheet. And it can also offer benefits such as retirement benefits or retirement income to their employees. And it's a way to retain and keep that talent inside their business for a long period of time. So maybe you've started down this infinite banking journey. You've learned about infinite banking. You understand the concept and the process of how it works. You've maybe even applied for a policy and begin designing a policy with an infinite banking practitioner. Or maybe today you just need to see a case study. How does this really work? And is this really impactful and helpful for my financial situation? And in today's episode, I'm hoping that this illustration, this case study that we're looking at today would be impactful for you and for you to take that next step in your infinite banking journey, whether it be in your own personal finances or something that you'd like to incorporate into your business as well. So let's get into it. First off, let's just go back over some of those lovely features of infinite banking and why you would want to use this in your business. First, it's a safe, guaranteed, tax-efficient place to store your capital. This could be cash reserves. This could be your working capital. This could even be a place where, ideally, where you store your profits until you're ready to maybe reinvest back into your business or acquire a new business or finance equipment. It's easily accessible. The cash value that's been stored up inside your policy can be accessed via a policy loan from the insurance company. And all that is the insurance company is collateralizing your death benefit and advancing you a loan that you can utilize today. In return, they will charge an interest rate. And that interest charge is optional. Now, I always advise people to pay back that interest and at least a little bit more to pay down those loans, to recycle that capital in their business. And in a way, they're creating a circular economy. They're keeping all the funds working inside their own balance sheet. Now, the beauty behind it is that taking a policy loan from the insurance company means that you are first in line to receive that loan. There are no credit background checks. There's no lengthy loan applications. You don't have to provide tax returns. There's no additional collateral. It's all collateralized from the death benefit. And those funds can clear as quickly as 3 to 5 business days. Whereas taking a small business loan to finance equipment might take several months. And you have to start thinking about, well, what's my return on time? How much time or how much return could I be earning if I had access to liquidity very quickly? And the example that we're going to be looking at is if I could access liquidity to finance equipment for my business, is that going to help my business over the long term? Or am I going to delay that return, that income that could be generated from that equipment because I've chosen to work with a traditional bank rather than utilize my own banking system? You have total and complete control. You can control the repayment schedule, the frequency of those payments, and there are no hidden fees or penalties to stress over, like you may see in some traditional bank loans. Now, this means that you can pay back those loans when you have cash available in your business, which means that you're able to smooth out your cash flow. And this is really helpful for businesses to have this access to liquidity and to be able to smooth out the cash flow, because 82% of businesses fail because of cash flow problems. And so if we can build a system and solve for that problem, the likelihood of our business succeeding over generations is going to increase. The tax-free death benefit. Your beneficiaries will be flush with cash when they need it the most. And an income tax-free death benefit can build generational wealth and can be recirculated back into the banking system. And I've got other videos on that as well if you'd like to see how that is demonstrated. Your beneficiary could be your business itself, or it could be your loved one. If it's your business, the beauty behind that is now the business is flush with cash and they're poised to grow exponentially because of that increased cash that they can then go and invest further. And lastly, my favorite, the uninterrupted compounding nature of an infinite banking policy. Albert Einstein calls this the eighth wonder of the world, and in my opinion, it's the magic sauce behind wealth building in general, but specifically behind infinite banking. What do I mean by this? Well, the premiums that you've paid to the insurance company, or if you like to think of it as your deposits in your banking system, are continuing to earn interest and dividends over many, many years, even though you've accessed some of that liquidity via the policy loan and are utilizing that in your business or in your personal finances. So you're able to build wealth by uninterrupted compounding. You're not interrupting the growth of your premium dollars or your deposit in your banking system, but you're still able to utilize it today and gain the benefit of financing equipment or expanding your business. Many different options there. So these are the reasons why we love infinite banking so much and why it makes so much sense for business owners and entrepreneurs. And of course, there's no secret as to how we do it. First, we pay our premium and to the life insurance company, and it's all stipulated there in the contract. And in return, we're going to take out the policy loan from the insurance company. And that could be used for anything. It could be used as working capital to smooth out your cash flow. Could be used to purchase inventory or finance equipment, or even to pay staff and employees, or to buy real estate and expand your business that way. You're not restricted on how you can utilize the policy loan, so long as what you're doing is still legal and above board. Let's take a little bit deeper dive into the steps of the process here, and then we'll get into the case study in a few minutes. So the first step, you need to fund the policy by paying your premium to the insurance company. Then we're going to access the cash value by taking a policy loan. And number three, we're going to continue to compound our wealth because it's uninterrupted compounding. And then lastly, we're going to be an honest banker. We're going to pay back that policy loan so that we have access to that cash value again. It's like a large line of credit. But the beauty behind it is this line of credit continues to expand and grow each and every year. And many people aren't used to that idea of getting better no matter what. Well, with infinite banking in correlation with your business, you have an asset that is getting better no matter what. And by treating it honestly and being an honest banker and paying back your policy loans with the same interest rate that you would be charged if you went to a commercial bank and received a small business loan, you will be able to compound your wealth over time and increase the value of your business over time and potentially increase retirement income for yourself or your employees. So this system solves for a lot of problems when it comes to small businesses. Let's get into a deep dive on how we utilize this. Let's look at the case study here to give an example of how this would work. Marcus here has been in business for 3 years, and this is the first year that he's profitable. In fact, he's got $25,000 in profit, and he feels confident that his small business will continue to grow each year. So he's looking to expand his equipment fleet in order to meet the demand for new construction homes. So he's in the construction industry, and he needs equipment to service that industry. So what is he going to do? He's going to take those profits and put them inside his life insurance policy in the form of the premium for $25,000 a year. And this could go on for several years. So this is his profits. This is a place where he's storing his profit until he's ready to utilize it, or he has a need for it. And as we shown earlier, the need that he has is he needs to finance equipment to expand his business. Rather than utilizing third-party lenders, he's going to use his own banking system to solve for that need. So here we see a table as to what his premiums and cash value and death benefit could look like. And this is going to vary across many different factors: your age, your income, your health. All of these things are taken into consideration when you're applying for life insurance. But here, just notice that in the first year, which is common with whole life insurance and common with any permanent life insurance, you see that there is a slight drag on his policy in that first year. His cash value does not equal his premium in the first couple of years even. But what we're going to demonstrate here is by utilizing this as a place to store his capital and to finance his equipment, his cash value and death benefit are going to increase over time. Here's just a little bit further on. After year 10, now his cash value has increased greater than the total premiums that he has paid. And by year 15, he's putting in that same annual premium of $25,000 a year, but his increasing cash value is now $39,000 in year 15. Imagine that, putting $1 in and maybe getting $1.50 back out. And of course, his death benefit has continued to rise as well. So he's put his profit into his banking system, but Marcus realizes that he's got a cash flow problem in year 1 and in year 2, as we will see here. Previously, he would have to inject cash into his business, come out of pocket, or he'd have to find a loan or some sort of line of credit to solve for this cash flow problem. And all I'm illustrating here is that this can be utilized for not only financing equipment or purchasing inventory, but smoothing out cash flow issues in your business. Now, it's probably no surprise that small businesses don't have the same equal cash flow every month like you would as a W-2 employee. If you're a salary employee, you generally know how much income your family is bringing in each month. But with a small business, you don't have that luxury. And especially in the construction industry here, where Marcus knows that there are going to be months where his business is very, very busy and other months where it can be incredibly slow. So to smooth out his cash flow issue, he's going to take out a policy loan to solve for that problem. So let's look at an example here. If he were taking out a bank line of credit of $10,000, let's just say, and maybe that bank is charging him 9.5% on that line of credit. On the right-hand side, you see a table, just an example as to what his payments towards that credit line would be, and the times where he needs to draw against that line of credit. Now, if you're not making your interest payments or any payment to your line of credit from the bank, what's going to happen? Well, you're probably going to see a ding in your business credit. But with infinite banking, if you had to make a $0 payment that month, there is no hit to your credit score. You would be charged interest just as you would be with the bank, but you're at least not having that issue of affecting your business credit score. So the total interest paid over just this 1 year period for that $10,000 line of credit, he's paying just over $600 throughout the year in interest. With his IBC system, his infinite banking system, the interest that the life insurance company would be charging is $311.50 for this example here. So what is Marcus going to do? Well, he's going to still charge himself the 9.5% that he would if he was utilizing the bank line of credit, because that's what's been familiar with his business up until this point. He's not changing really much of the cash flow if he doesn't have to here. So this is the best case scenario. So that interest savings of $604 minus $311 now becomes additional premium or additional paid up additions inside of his policy, which will continue to grow and expand and compound in a tax-deferred nature, the most preferential treatment that a business can grow their profits in. But here's another example of a term loan. Still another $10,000 loan over 5 years, this time at 9%. His monthly payment to the bank that he would be used to be making is $207.58. And the total interest paid over those 5 years is $2,455. Remember how I said the bank was only charging 9% interest? But yet, if you calculate the volume here, he's paying 24.5% of every dollar is going towards interest over those 5 years. Now here, we're going to compare this against his banking system. Still taking out a $10,000 policy loan in year 2. He's going to pay it back over 5 years. And the interest charge that the insurance company is going to charge him is 5%. But he's going to pay above and beyond that. He's going to recapture the interest that he would have been paying towards the bank. And now, once again, that becomes additional paid up additions inside of his policy. In this case, he was able to recapture $1,132 in year 2 through year 7. So before he was using any of the loans, let's just take a look at his cash value in year 10, $256,000 in cash value. Now, after he's utilized both the line of credit feature in the first year and the term loan in the second year, he smoothed out his cash flow problem, and the interest that he has recaptured has now gone into his cash value. In year 10, you see the increase in cash value there. Now his cash value is almost $258,000. As well, the death benefit has increased. The dividend has increased. The policy is becoming more efficient. This is all by just changing who receives the interest payment on those loans that he needed for his business. Was it going to be his own banking system, or is it going to be a traditional lender? By doing it with his own banking system, he's actually adding capital to his business over time, rather than paying that away and not recirculating those dollars back into his business that he could utilize again and again, like a large line of credit. So here's an example again of how this is working. He's ready to step this up, to take it to the next level. He wants to purchase his first piece of equipment. So he's going to do this in year 3 of the policy. He's going to purchase a Kubota SSV 75 skid steer, which retails for about $55,000. He's going to pay this back over a 4-year period of time. Now, if he were renting this piece of equipment, the monthly rate that he might be charged in rent could be as high as $3,000 a month. So over 48 months, over 4 years, he'd be paying almost $144,000. That doesn't sound like a good trade here. So maybe he's used to leasing his equipment at a monthly rate of $1,550, or over the entire 48 months, that would be a payment of $74,400, which means that over a third of the dollars that he's paying for that leasing equipment is being charged as quote-unquote interest. If he were financing this at 9% over that 48-month period, that monthly payment would be $1,369. And about 20% of every dollar paid back to the bank is interest. Or he could use his banking system, which is my favorite here. The monthly rate that would be charged if he were to amortize this out, and the insurance company continues to charge him the 5%, his monthly payment back to the insurance company would be $1,267. And he could recapture as much as $13,000, or in the instance that we're going to be looking at, he's going to recapture $4,896, which is the difference that he would be paid or charged from the traditional bank versus his own banking system. And that $4,896, once again, becomes new premium, becomes paid up additions from year 3 to year 7. His policy is continuing to grow and compound as a result. So the total that he paid was $60,797 to the insurance company. He retained, however, $55,000. His entire principal is back as available cash value for him to utilize again for the next equipment purchase. The total interest paid to the insurance company, however, was $5,797. And the interest and dividend growth on the amount that he recaptured over that 48-month period has now swelled to $5,147. How did I get that number? Well, we take that $4,896 that he recaptured, it becomes new premium, and by the time he's done financing this piece of equipment, that number has grown to $5,147, because as he's paid more premium, he's gaining more interest and dividends inside the policy. It's compounding that way. So he didn't really do anything different. He's used to financing it with a different bank. Now he's using his own banking system. And as a result, he's actually adding more cash to his business. So let me ask you this. How much do you think it cost him for this Kubota? He paid $60,000. He retained $55,000. His interest to the insurance company was $57.97. But by the time he's done financing the equipment, the interest that he recaptured has now grown to $51.50, let's call it. In this example here, I want to make an argument that Marcus bought that Kubota for $650. He's retained all of his principal. He's gotten that all back. He's recirculated that into his business. The interest that he paid to the insurance company and the interest that he recaptured by financing it through his IBC policy, now it's really, quote unquote, a loss of $650. Do you think Marcus can make $650 off of that piece of equipment? Oh yeah. And when you think about it this way, that's a big return. How much income is that piece of equipment going to draw or gain his business just for a cost of $650 when it's all said and done? That's a big return on investment, in my opinion. So just to illustrate this a little bit further, once again, the before here in year 10 is after he's taken out the line of credit in year 1, after he's taken out the term loan in year 2, and by year 10, let's just see that it was $257,998 as far as his cash value. And now after he financed this Kubota, his increase in cash value at year 10 is $6,138. In year 15, it's an increase of $7,637. Because he's recaptured the interest, that became paid up additions, which has grown and compounded, earning interest and dividends on that growth. And over time, now you see that his business has more and more cash value just by financing his equipment himself, as opposed to utilizing third-party lenders. All right, let's put this on afterburners here. Equipment financing on steroids. In year 3, we already looked at him financing $55,000 for that Kubota. In year 4, now he's going to finance a backhoe, which is roughly $59,000 brand new. In year 6 of his policy, he's going to finance his largest equipment purchase to date, which is a Caterpillar excavator, which retails for about $107,000. All along the way, he's continued to pay his premium. His profits are being stored inside his life insurance policy, that $25,000. He's added to that premium as in the form of paid up additions by recapturing the interest he would have been paying to third-party lenders. Now he's utilizing it in his own policy here. And very quickly, he's seeing equipment purchases. His business is expanding very rapidly. In just a few short years now, he's financed 3 pieces of equipment. Let's take a look here. The total that he paid for those 3 pieces of equipment would be $247,000. However, he's got all of that back in the form of his principal, $221,000 of principal back. So the total interest that he paid to the insurance company for those 3 pieces of equipment, $26,500. The total interest recaptured, $22,286. By the time he's done financing this equipment, which would be year 10, year 11 of his policy, the interest and dividend growth on the amount that he recaptured has now grown to $27,403, which is greater than the total interest that he paid to the insurance company for those 3 pieces of equipment. Do you understand what's going on here? He's kept all the principal back inside of his own banking system. He's been able to recirculate that time and time again to finance more and more equipment to grow and scale his business. The interest that the insurance company was charging him is being totally offset by the growth of the interest he recaptured and the growth of the policy over time here. Here we're actually showing an increase. We're showing, quote unquote, like a profit almost of The amount that he recaptured, the $22,286, by the time he's done financing these three pieces of equipment, that has grown to $27,403. But the interest that he was charged by the insurance company, $26,500. This is like he's gaining money. He's building wealth in some weird way by financing his equipment. Just imagine how that could change your business. No longer are these seen as a loss. Not only are they driving profit and revenue back to the business, but just by changing the way you finance it, he's actually compounding his wealth and becoming more profitable and scaling his business and solving his cash flow problems. This is a system that is so unconventional to many small business owners, but should be utilized by every small business owner, in my opinion. So just again, to look at year 10. Year 10, before he financed any of the equipment, meaning he had the loan of credit, he had the term loan in year 2. Once again, that cash value is $257,998 in year 10. After he financed 3 pieces of equipment, his total cash value is $285,401, which was an increase in cash value at year 10 of $27,403, just like I showed on the other slide. By year 15, he hasn't financed any more equipment. He stopped. He just to show you how that compounding over time has grown. In 5 years' time, now that increase in cash value at year 15 is $34,099. His death benefit has increased to almost $70,000. The dividend has increased to almost $1,000 a year, and that's going to continue to grow and compound as a result. I just show you in year 10, the premium after he financed those 3 pieces of equipment was $27,515. Well, wait a minute. I thought he was only putting $25,000 of profit, storing that in this system here. I'm showing you what would be the case if that $27,515, that additional above the $25,000 profit is how much paid up additions he's contributing back into policies. So it's not any more out-of-pocket expense. It's what the bank would have been charging him anyway, but now he's able to recapture some of that interest here in the form of the premium. So he's solved for his cash flow problems. He's solved for his need to expand his business and finance equipment. And he's done it in a way that's built him wealth over time and made the business stronger, not only on the balance sheet, but just in practice of not having to go through those lengthy loan applications, tax returns, the headaches and hassles. He's got a simple system that he owns and controls and has the first right to any loan inside the policy. And he can utilize that for many, many different situations. In this example, we looked at just his equipment financing. In a few short years, he was able to finance 3 pieces of equipment. And it could continue to grow and compound each and every year thereafter if he wanted to. I just stopped at those 3 pieces of equipment here to demonstrate the power behind becoming his own banker. So was it worth it? Was it worth it to him? Well, he created his own personal circular economy. He's kept all of his dollars inside his banking system rather than sending that away and leaving his business like he was used to. He's now able to recirculate many of those dollars and utilize them time and time again, as opposed to having to go to the bank every time he needed a new piece of equipment and beg for a new loan. He's optimized his cash flow. He's stabilized it with the most efficient, most flexible terms available. He's recaptured the interest. He's no longer paying high interest rate debt to third-party lenders. He's able to keep that for himself and allow that to grow and compound inside of the policy and inside of his business. Now, in these examples here, I looked at 9 and 9.5%. And just at the time of this recording here, small business loans from SBA type loans, they could be anywhere from 11.5 to 13, 15%, depending on your credit score. So I think I'm being pretty generous there at 9.5%. He scaled his business. His equipment fleet has expanded quite rapidly without the need of outside debt that would have restricted the growth of his business, because that would have been dollars sent away, never to be recirculated, never to be recaptured. and he's enjoyed the fruits of his labor of uninterrupted compound growth. His total profits are continuing to grow and compound without the effect of taxes and interest to third-party lenders. Those are two big wealth killers, not only for his business, but for you personally as well. If we can control those two environments here, you're going to be much better off compared to his competition. And that's a good point here. Think about your competition and business. How are they financing pieces of equipment? Are their dollars leaving their business, or are they able to recirculate them? Are they recapturing high interest, or are they sending that off to bank, paying 20 to 30% volume of interest on their pieces of equipment? If you have a competitive advantage just by the way that you finance the needs of your business, you're going to be much better off. You're going to be able to absorb more market share. You're going to be able to absorb more businesses, eliminate many of the competition by doing this over long periods of time. And as you become more profitable, as his business continues to grow, he can have more of that revenue, more of that profit could be added into his policies, continuing to grow the capital base for him to finance more equipment or more inventory, or you name it, whatever it is that your business needs. As you grow and as you become more profitable over time, store it here first. Enjoy the uninterrupted compound growth. Enjoy the system that you can recapture interest and create that circular economy for yourself. You're going to be much better off compared to your competition. So how does he start? How do you start if this is something that you're interested in? Well, first you need to learn. Many of you have learned about infinite banking through this podcast and our YouTube channel. It's time to sit down and apply and design for a policy. Work with us and our team, authorized infinite banking practitioners, and we can show you, demonstrate for you how these systems work. And step 3, you just need a bank. Do it like you've already been doing it. Just change who the dollars are going to. Instead of third-party banks, it's coming back to your system. If you're interested in working with us here, you can visit us at capitalcontrol.org or send me an email directly, derek@capitalcontrol.org, or scan the QR code there, and that will take you to our scheduling link, where you'll be able to sit down for 30 minutes and have a free strategy session with myself. And I can demonstrate for you and continue to help you in your business to see the power of becoming your own banker, recapturing debt, recapturing interest, growing your wealth, uninterrupted compounding in the most preferential tax treatment possible. If you'd still like to look at our other resources, of course, check out the YouTube channel. We've got many videos already there, and our podcast as well. Once again, I want to say thank you to our listeners and subscribers for your support, and I hope that this episode has proven itself to be valuable to you. We'll see you in the next one. Thanks.